Welcome to This Explainer. Today, we're unraveling a pretty fascinating financial mystery. A massive, globally recognized software giant is facing what analysts are literally calling an existential market crisis. So let's get right into the numbers. Okay, let's dive right into this. Minus 70%. That is the staggering drop in Adobe's stock price from its all-time peak. Now, for a company that essentially built the creative digital world as we know it, a crash of this magnitude begs a massive question from investors. Is the traditional software as a service, or SaaS model, actually dying out? To figure out if this intense market panic is justified, here's our roadmap for today. First, the fall of a giant. Second, the price war. Third, the lifeline. Fourth, the leadership vacuum. Fifth, the real financials. And finally, number 6, the future and catalysts.
All right, part 1, the fall of a giant and the impact of artificial intelligence.
So, the overarching fear sweeping the market right now is this idea that AI code generation is making software so incredibly easy to build that traditional SaaS companies might just become obsolete. But look, we really need to separate the hype from reality here. Sure, an individual can use AI to cobble together a basic internal app with zero coding experience. That's true. But actually deploying a product to the public, that's a whole different beast. You've got to guarantee absolute server uptime, manage complex data privacy laws, and ensure ironclad cybersecurity. AI doesn't just magically replace the incredibly secure infrastructure required to run a multi-billion-dollar enterprise app.
Which brings us to part 2, the price war. Adobe versus the free alternatives. Now, while AI might not kill enterprise SaaS overnight, it absolutely empowers much cheaper competitors to challenge the established giants. And this brilliantly illustrates the real threat. On one hand, you have the Adobe Suite. It's an inflation-hit subscription that can run you up to €80 a month. And let's be honest, that can start to feel like a second rent payment. But then, on the flip side, you've got really powerful alternatives like Canva's, Affinity, or DaVinci Resolve that are either completely free or just charge a one-time lifetime fee of around $300. If you're a freelancer, the economic incentive to just jump ship and pocket that subscription money, it's enormous.
Move into part 3, the lifeline, those invisible competitive advantages.
So you're probably wondering, if the freelancers are finding cheaper options, why aren't massive enterprise clients immediately abandoning Adobe too? Well, it all comes down to invisible competitive advantages, what we call economic moats. The first big one is switching costs. This is the hidden financial and operational friction a business faces when it tries to change up its software ecosystem. Think of it like this. Imagine trying to switch to a free Linux operating system for your personal computer. The software itself is totally free, but the massive hidden cost is the sheer agony of spending weeks relearning all your favorite keyboard shortcuts and figuring out how to do literally everything over again.
Now multiplying that headache by 1,000. For a large design studio, the reality of switching away from Adobe is just an incredibly painful multi-step process. Step 1, you have to retrain hundreds of employees. Step 2, you have to completely overhaul established, complex daily workflows that have been in place for years. And step 3, you even have to change your future hiring requirements, literally retraining your HR department to look for entirely different software skills on resumes. So for big business, a cheaper monthly subscription definitely doesn't always equal a cheaper operational reality.
The second moat holding Adobe up is the network effect. This happens when a product becomes more valuable simply because more people are using it. Over decades, Adobe has effectively become the default language of the entire creative industry. I mean, there is just an endless sea of internet tutorials, third-party plugins, and entire school curriculums dedicated solely to Photoshop and Premiere. Leaving Adobe means leaving that massive, established support network completely behind.
Part 4, the leadership vacuum, a crisis at the absolute worst possible time.
Now, here is the crazy plot twist of our investigation. The real vulnerability driving that 70% drop might not just be external AI competition, it might actually be a sudden internal vacuum. Let's walk through this timeline because it's pretty wild. In spring 2024, the CEO, who expertly guided the company for 18 years, announced he's stepping back. Then, right after, in June, their historic CFO unexpectedly exits. So today, right smack in the middle of the biggest technological shift in 20 years, the company is relying on an interim CFO. The market absolutely hates uncertainty, and losing your top executives during a storm, that's a massive red flag.
Let's look at part 5, the real financials, the discrepancy between the stock market and the actual balance sheet. Now, what's really interesting here is the incredible discrepancy between the stock market's absolute panic and Adobe's actual physical balance sheet. Just look at these internal metrics. We are talking about an almost unbelievable 90% gross margin. Operating margins are highly stable at 36%, and their return on investment is 48%. Add to that at 13% year-over-year revenue growth. I mean, by fundamental business standards, these numbers directly contradict the narrative that this company is somehow falling apart.
And we cannot ignore this number, $10 billion. That's the sheer scale of Adobe's annual free cash flow. $10 billion in clean annual cash is a massive war chest. Plus, to put it into perspective, their debt-to-capital ratio is extremely healthy, sitting well under 40%. They aren't burning cash on desperate, unfunded ventures. They're highly solvent, operating from a position of serious financial strength. In fact, even if we play devil's advocate and completely stress-test their valuation models, like if we input incredibly pessimistic assumptions, assuming declining future revenue and operating margins crashing all the way down to 30%, the math shows the company is still arguably trading at a fair value right now. It's definitely not massively overvalued, even in a hypothetical worst-case scenario.
Finally, part 6, the future and catalysts. Basically, how they get out of this mess.
So what will it actually take for the market to wake up from this extreme pessimism? How does Adobe escape? Well, there's a famous financial concept inspired by George Soros that says markets can remain irrational longer than you can remain solvent. The real danger here is a self-fulfilling prophecy, right? If the market irrationally hates SaaS companies for too long, their stock stays depressed. That makes it harder to attract top talent and finance day-to-day operations. Eventually, that irrational fear becomes a reality if the company doesn't aggressively take action.
To break that cycle, Adobe needs clear, undeniable catalysts. First up, they need to launch a native AI killer feature, something completely integrated, like seamless AI generation directly inside the Premiere timeline that competitors just can't match. Second, strategic M&A. With $10 billion in cash flow and the Figma deal officially dead, they could outright acquire an amazing AI tool, like Xfield, for example, to instantly boost their tech stack. And third, they absolutely must resolve that leadership vacuum to restore confidence on Wall Street.
So here is the multi-billion-dollar question we're leaving you with today. Is the market actually right about the inevitable decline of traditional software companies in this new age of AI? Or, given the rock-solid fundamentals, the massive moats, and the huge cash reserves we just looked at, is this extreme panic actually hiding a generational investment opportunity? Thank you so much for joining me for this explainer. Keep analyzing those numbers, and I'll catch you next time.